Watch a live financial ticker for 5 minutes. The numbers stutter and shift. A portfolio swings wildly from green to red, bleeding value one moment and surging the next. This erratic cadence feels familiar because it mirrors the internal volatility of a typical Tuesday, that exhausting experience of holding your discipline together in the morning only to watch it collapse by the afternoon. We live in a culture obsessed with the immediate present. Our feeds update by the second. We track our sleep scores, our daily steps, and hourly productivity. This saturation in short-term data warps our perception. We start treating today's isolated mood or a single closing bell as the final truth of our situation. The danger of that hyperfocus is the reaction. When you respond to every sudden spike or minor dip, you generate panic. You strip away context. By staring too closely at the noise, you lose sight of the underlying reality of what you are measuring. Without a structural filter to separate passing episodes from permanent direction, you are flying blind. You are reacting to shadows, whether you are navigating the global markets or your own life. The attempt to build that filter began in the late 19th century. Financial journalists like Charles H. Dow, William Peter Hamilton, and Robert Rea faced this exact problem of deciphering noise. They were staring at a rapidly industrializing American economy, exploding railroad networks, new manufacturing centers, and a flood of untested capital. It was a chaotic environment with no precedent for tracking long-term economic direction. No one had a reliable map. Dow recognized that trying to predict the exact tops and bottoms of such a market was a foolish task. Instead, he prioritized disciplined recognition, looking past the psychological panic of the crowd on the street to identify where the machine was heading. The framework they developed provides a discipline for distinguishing between temporary illusions and established direction. Dow theory rests on one central claim: the market moves in 3 distinct simultaneous layers. Focusing tightly on a short timeline, we see the first layer, minor movements. These are the daily fluctuations, the short-run noise. Driven by immediate reactions to news and rumors, these minor swings are emotional and statistically unreliable. As the view pulls back, we see the second layer, secondary reactions. These are intermediate corrections that run counter to the main direction for weeks or even months. They feel decisive to the people living through them. When a secondary reaction hits, it feels like the trend has ended. When we zoom out to a multi-year timeline, the picture changes. This is the third and most important layer, the primary trend. This is the long-run direction. From this height, that decisive secondary dip is revealed as a harmless pullback on the macro scale. Structurally, a primary uptrend is defined by a sequence of higher highs and higher lows. Even when the price drops, it finds support at a level higher than the previous drop. The mechanical lesson is simple. A pullback is not a reversal. A healthy primary trend absorbs the countermove and persists. To prevent overreacting to false alarms, Dow built a safeguard called the rule of confirmation. One isolated metric is never enough to prove a change in direction. Dow relied on 2 independent averages, the industrials and the transports. To declare a true market signal, both lines had to agree. The goods had to be made, and they had to be moved. Watch when one index breaks to a new high, but the other fails to confirm it. In Dow theory, this is divergence, a warning flag suggesting the broader movement lacks total participation. The governing discipline remains the same. A trend is assumed to persist until there is confirmed evidence of a reversal across multiple measures. This forces patience. It is safer to be slightly late to recognizing a real reversal than to panic at a false alarm. These technical rules for identifying a market trend provide a vocabulary for evaluating the trajectory of a human life. Your primary trend is your long-form direction. It is the overarching trajectory of your character over a decade, the accumulated weight of who you are becoming. Your secondary reactions are the inevitable seasons of testing. This might be a period of intense doubt, a temporary backslide, or a localized failure that lasts for weeks. Your minor fluctuations are daily emotional noise, a bad mood on a Tuesday, an isolated argument, a fleeting temptation. Our common error is mistaking a minor daily fluctuation for a change in our primary trend. We have a terrible afternoon and decide our character has collapsed. We have one great morning and assume we have reached maturity. But if the structural definition of an uptrend holds, a person's core direction is not destroyed by a single season of failure. The trajectory survives the dip. The rule of confirmation applies to character just as it does to the industrials. One isolated victory does not equal maturity, and one secret failure does not equal total collapse. We look for corroborated evidence across multiple domains: speech, relationships, money, and private habits. If someone claims a massive personal breakthrough, but their daily conduct fails to confirm it, that is a divergence. The signal cannot be trusted yet. There are limits here. Human beings are not charts. We cannot reduce grace, forgiveness, or restoration to price action. A change of heart does not always follow a geometric pattern. But the theory gives us structural sobriety, the ability to step back from the blinding chaos of the immediate moment and look at the larger map. It replaces the question, "How do I feel right now?" with a more disciplined inquiry. What direction is my life actually taking?